So if you're gonna borrow money, how do you get the lowest interest cost? I'm gonna give you a little bit of a different answer. The first thing I would say is borrow from yourself, right? Now, what do I mean by that? When I borrow money, I'm borrowing from a bank. Now, the bank has to take the money from somewhere. It's not their own. They don't loan out their own money, right? So a bank is gonna loan money from their deposits, and in that case, their cost is whatever they've gotta pay those depositors, which right now is like half of 1%. Half of 0.1%, sorry. The other one is gonna be borrowing from the Fed or from another bank. And at that point, they've got, the funds rate that they're paying on that money. And so they've got a cost there as well. So you're always gonna have a higher cost based on their cost. Now, if I borrow from myself, what that means is I have an asset. For me, I like doing this with gold, silver, life insurance, real estate. I have an asset and I get a line of credit against that asset. And so I make sure that when I have that line of credit, the cost of interest is lower than the amount that asset's going to appreciate at. An example would be I borrow at 4% on gold and the gold appreciates at 8%, right? So I can make money instead of paying interest, right? So if we look at this as like a scale, at the top would be the very best. I borrow and actually make money to borrow, right? So if I borrow against a life insurance policy, it costs me 1 to 3% in interest to borrow. I'm making 3 to 5. That's going to mean that I'm making a positive spread. I'm making profit on my own loans. That's better than a cheap interest rate, right? I'd rather get paid than pay. So that's going to be the best. The next one is going to be zero interest, right? So if I can borrow at 0% interest, sure, I'm still giving up income to a bank. That's not as good as making money on my own loans, but it's better than paying interest. Last is paying interest, right? That's going to be at the very bottom of the scale. And that's in any form. Obviously, the higher the interest rate that I'm paying is, the worse off I am. But if I'm paying a low rate, I can use things like credit. I can use things like cash flow or income. I can use things like collateral, building up my reports, all to get that interest lower. But none of that's going to beat making money when I take loans. If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that. Number two, we do a free course on Fridays on personal finance. Okay, you can also get the link for the description there too. And then finally, if you have a desire to start getting help walking through these different phases toward financial freedom, book a call with my team. Go to our website, set up a call. We're able to help out and answer questions. That's how we can help you. Thank you for watching. Like, share, subscribe. Make sure you turn notifications on, and I will talk to you guys on the next video.